Wow, the Consumer Price Index number is out today, and it is 7% year over year. We have 7% inflation in the year 2021. That is the highest since E.T. phoned home, as Zero Hedge put it, 1982. Back in, wasn't that also the year of the video game crash? I believe, people blame, the E.T. video game debacle and the massive landfill of ET video, games for the Atari 2600. They blame that on it just being such a terrible game, which it is. But it's probably more just the video game market was so oversaturated at that point with shovelware. It was right on the verge of the video game crash. But what the hell does that have to do with 7% inflation? Why am I getting off topic? In normal times, this would be terrible news. Interest rates should be rising on such news. You would think in a normal economy that interest rates would be above the rate of inflation. We used to call that the inflation premium. You see, you have a positive rate of interest, whatever it is, and then you have to add in whatever the rate of inflation is on top of that. So even if you have near zero interest rates, interest rates should always be above the rate of inflation. But that's not the case in modern America. We have negative interest rates, which means if you save your money, if you lend your money, if you invest your money, you're losing money. That's right, you're incentivized to go into debt. If you go into debt, let's say you borrow money to buy a house at 3.5%, and inflation is 7%. Inflation is double the interest rate on your house. All else equal, you're being paid to own that house. You're being paid to go into debt. As long as, whatever you're borrowing at, as long as your rate of your interest rate is below 7%, for as long as inflation is 7%, you're making money. And as we've learned from Europe, a society cannot function on negative interest rates. Interest rates are not negative. It's not natural. It's not how society is supposed to function. You don't incentivize going into debt and disincentivize borrowing. That's the opposite of, disincentivize lending. That's the opposite of what you want. You want people who have money to be incentivized to lend it out so that they can invest in growth and build up the economy so that we can increase productivity. But if you've got negative interest rates, your economy is not growing. Your economy is shrinking in real terms. I have to say, if we've got 7% inflation and a 1.7% yield on the 10-year bond, 10-year treasury, I highly doubt that the U.S. economy, I didn't look at the exact GDP numbers. I don't know if they're entirely out and revised and all that, real GDP numbers or nominal GDP for 2021. But I have a feeling it might be below 7%. I mean, we certainly know that wage growth is below 7%. And so, ordinary actors in the economy, people working, they are not being helped right now. They're not, doing well in spite of inflation. They're worse off because of inflation. Inflation is rising faster than their income. And so the average American is getting poorer. That's how this works. The Fed for years complained about, we have this stubbornly low inflation. It's terrible. By our rigged metrics, inflation is only, 1 or 2%, or it's under 2%. That's terrible. In reality, it was higher than 2%. But, the way that the Fed calculates inflation is so ridiculous that it looked much lower than it was. They have all these tricks like hedonic adjustments and substitution that they use to try and understate inflation. But even with all those tricks that the Fed plays, we still hit 7% in 2021. That means that the real rate of inflation, if you, I forgot to check shadow stats. I'm so dumb. I should have checked shadow stats. I wouldn't have to tell you it's double digits. I give you the exact number. But I guarantee you go and you check shadow stats, which has the inflation rate calculated the way it was traditionally calculated, like back in the 70s and 80s, you'll see that we have double-digit inflation. And it will become even more apparent that inflation is much higher than wage growth. And so if you're working in America, you're getting poorer. Congratulations. Yet despite all this, you look at the stock market, and it was a wonderful day. Stocks are happy. Why? I guess because, well, it was only 7% inflation. Could have been worse. It is true that the so-called consensus estimate, the wizards of smart who are surveyed, again, I believe by Reuters, hey, what do you think the number will be? Their average guess was 7%. And so that when it turned out to actually be 7%, well, then people said, oh, well, look, it wasn't over. It wasn't higher than we expected. I guess it's time to buy stocks. Any excuse to buy more stocks, am I right? Because when you've got double-digit inflation, essentially, but officially high single-digit inflation and 0% interest rates, what else are you going to do with your money? You got to put it into stocks. That's the only thing that has nearly a high enough rate of return to escape inflation. And arguably it doesn't do that depending on how you calculate inflation. But still, stocks, they're the best game in town. It's the cleanest dirty shirt in the hamper. And in high inflationary environments, it's not like stocks go down. Quite the opposite. People, often cite the modern example of Venezuela. Their stock market went to the moon as the bolivar went through the floor. And while stocks are not necessarily a perfect inflation hedge, they're better than just holding paper dollars or treasury bonds. Yet, the official narrative is still that we're going to get a Fed rate hike, which, I guess conventional wisdom would dictate, oh, well, we have high inflation. Yeah, the Fed's going to have to hike rates. Well, a 25 basis point, i.e. 0.25% rate hike, is not going to do anything about 7% inflation. And the Fed is not going to hike Fed funds above 7%. That's Looney Tunes. So the Fed is still going off of the hope that this is transitory. And for all of our sake, we better hope that it's transitory, because the Fed is not going to fight 7% inflation if it stays here. I will concede. It's possible at this point, because you've got people like Bullard at the Fed saying, oh yeah, March rate hike highly likely. That seems to be baked in the cake, and because it's so expected, highly expected by the market at this point, I would see Powell going forward with this first rate hike in March. But again, no more than that. But this one, it's already priced in, and at this point, if he didn't hike rates, it would spook the markets. So we will get a dovish hike, which is a term I haven't used in quite a while, but I believe I used it. Me and many others used it during the last hiking cycle, which was ultimately aborted. It was never finished. But a dovish hike is when Powell comes out, yeah, he hikes rates, but then he comes out and he does his press conference, and he talks all about how, no more rate hikes. I'm really worried about stuff. Maybe we'll go back to QE. We don't want to rush anything. We're not going to have any schedule. We're going to play wait and see with this first rate hike. We could wait a whole year before the next rate hike. Things like this. That's the kind of rhetoric that you would expect with a dovish hike. And since the hike is already priced in to the market, the dovish rhetoric post-hike will be net dovish. And so that means that we could have very easily a day where the Fed hikes rates, the stock market surges because the rate hike's over, there it's done, rip the Band-Aid off, and Powell is signaling dovishness into the future. So another reason why stocks would surge. And then we see yields plunge. And so it's kind of a, buy the rumor, sell the fact situation combined with another buy the rumor, sell the fact situation. And so people, will be probably shorting treasuries going into the hike, and then as soon as the hike is done, the one hike that everybody's priced in, as soon as that's done, yields are going to plunge, i.e., people are going to buy up treasuries. They're going to cover their short positions, and they're going to go buy stocks. But they can't buy too much, or else that will risk a second Fed rate hike. So the market is going to have to fall after that at some point. We're going to need to see more sell-offs, but on the day of the hike itself, I think that it'll probably be a pretty rosy atmosphere. Especially since, Powell is going to talk about how, we expect, inflation to moderate by mid-2022, which is what they're saying now. And of course, they said the same thing last year. Not that they expect inflation to moderate by mid-2022. I mean that they expected inflation to moderate at whatever point they were talking, within a couple months. Oh, this is totally transitory, short term. It'll be over soon. But it's not transitory, and even if it were, it's not like transitory inflation is going to be followed by transitory deflation. It's not like prices are going to go back to where they were. No, prices are much higher now than they used to be. You are relatively much poorer because prices of goods have gone up, your wages have not, in relative terms. And that's not going to be undone. You're not going to get that purchasing power back. We've got two options here: stagflation or just stagnation without inflation. For those of you who don't remember, stagflation is stagnation, economic stagnation, and inflation, price inflation. Right now, we're in the stagflation stage. If inflation stays high, at or above 5%, we're going to have stagflation. If inflation is, it does finally end for whatever reason, we're just going to have stagnation. But either way, we don't have rosy economic times ahead. The boom is in prices, not in wealth. Not in wealth for individual people or for ordinary people. It's a boom in wealth for asset holders, people who already own assets. And really, that's been the story of the last 40 years. Everything is so much more expensive now. All assets have gone up, year after year since the early 1980s. And so all the boomers who owned assets back then or have bought assets since are sitting pretty on a big nest egg. They're doing well. And everyone younger than the boomers, they ain't doing so well. We haven't been able to accumulate wealth because everything was already too expensive, by the time we came of age. Maybe Gen Xers not so much. Gen Xers have had a shot. But millennials and, and Gen Z and whatever they want to call the people after that, I don't know, Gen non-binary, I kid. If you think about it, if you were a millennial, you graduated college, let's say around 2008, you couldn't find a job, and, things were cheap, and then, by the time you did kind of catch your footing a little bit, you did get a job. Well, all of a sudden then, real estate prices started to rebound, because remember, at the bottom of the real estate market, prices only got down to where the historical average was. Back the prices that the boomers, the Gen Xers, the silents, the greatest generation, it only got back down to the prices that they used to pay, for like a year, and then it went back above trend again. And so millennials never really had a fair shot, because when things were cheap, they were all unemployed and, out of college and deep in debt, student loan debt anyway. They weren't in no position to buy homes. And then me, I'm somebody who's younger than the millennials. I certainly never had a shot. I mean, I was in middle school when real estate was cheap. And the same goes, of course, for the stock market. That was cheap back then, too. People who bought stocks back then, they're doing great now. But if you're one of these retail moron longs who's been piling into stocks ever since the stimmy checks went out, sure, you've made some now, but, when the house of cards comes tumbling down, it's going to settle out somewhere much lower than where you got in, because you just got in so far late in the game. If you buy and hold, you're going to get creamed. Now, before I go, I do want to address the topic of what exactly is leading to this high rate of inflation. It's easy to say, okay, well, Fed has 0% interest rates. Well, the Fed's had 0% interest rates since 2008 or thereabouts. '09, I guess, whatever. Yet we haven't had 7% inflation till now. The last time we had 7% inflation, as I said, was 1982. So it's not just 0% interest rates. That's not the explanation. You could say, well, it could be record deficit spending. And I think that's probably a pretty good guess. We do have record deficit spending. Now, we have record deficit spending every year, yes, pretty much. But this is, new, and it's it's overtly stimulative. They're trying to dump it directly into the economy, which causes inflation. But also we also have to take into account that CPI, consumer price inflation, is not just it's not just a factor of the money supply. It's just measuring prices. It's not measuring the money supply. We don't have a decent measure of the money supply, unfortunately. M1 is pretty much useless. M2 was never, or hasn't been very useful in a long time. M3 was the best they ever came up with, although it's probably obsolete now, and they don't even run the series anymore. So we have no real money supply metric. We don't even know if on net more money is being created or destroyed. We have hints, but we have no objective way of knowing how much money is being created. And so, leaving the money supply aside, the other factors that we have to deal with is supply side pressure. You've got the labor shortage. You've got the broken supply chains, which continue to be broken. Supply chains are a complex thing that were built up and developed over decades or centuries in some cases. And when they were completely broken in 2020, you can't expect them to be put back together so soon. And who knows, when they are put back together, they probably will be put back together completely differently. It'll just have to be rebuilt from scratch in many cases. Of course, this is going to vary from product to product or region to region. And so in the meantime, supply is going to be severely restricted relative to 2019 levels. And so that is going to have a severe impact on prices. And supply chains are not something that central planning or monetary policy or Federal Reserve jawboning can fix. And so even if Powell had the courage to fight inflation, which he doesn't, it's unclear, even if he did the right thing and, let's say, CPI is at 7%, so he raises Fed funds to, 8%. It's unclear whether or not the consumer price inflation that we're seeing could be completely remedied by just jacking up interest rates. It's unclear what portion of of consumer price inflation is, what percentage of that is attributable to monetary policy, and what portion is attributable to broken supply chains, and furthermore, what portion is attributable to the labor shortage. There is a shortage of labor, at least where I live. The population is exploding. They're building apartments left and right. The streets are packed. Compared to 2 years ago, where I live, when I try and go out on the streets, it's bumper to bumper traffic, almost all day. And this used to be a quiet part of town just a couple years ago. Yet, all the local businesses, places that have been open for my entire life, that I go to frequently, having trouble finding help, severely understaffed, cutting back on their hours, not being open all the time. I've talked about this again and again, because it's a problem that's not going away. And I think a simple explanation is that, where do you see the labor shortage most often? It's low-end positions, low-wage workers. And then I look at the rents around here. $2,000 a month for really anything. A very limited supply of, smaller apartments that are under $2,000 a month. There's simply nowhere for, lower wage workers to live. And, no matter how many housing units or apartments they build, it's not going to change. even the so-called affordable housing that we have here. The more they build, the more prices keep going up. Because as they build, they gentrify these areas, these less densely populated areas that have, let's say, more wild-looking vegetation, maybe open fields or woods or whatever, as they, buy up individual parcels and build 5 houses at a time, or 20 houses at a time, or, 1 or 2 apartment buildings at a time. The area is being upscaled. It's becoming a ritzier area as they build more. And so adding this new supply of housing is attracting more and more people from the outside to move here. They're not adding on net to the supply of housing available to people who already live here, or to people, who might want to move here and work in those, lower wage jobs. It is a bit of a mystery to me where all of these people are working. It's something that I wondered when they started building the apartments. Who is it that's going to live in these buildings? Is this just, the laptop class, the work from home people? Because I know this is not a phenomenon that is unique to my area. This is true in places across the country, and especially these fast-growing places, whether it be Austin or Phoenix or probably Vegas. Salt Lake City, I would imagine. All of these, fast-growing places. We're having housing built just everywhere. The supply of housing, in absolute terms, not necessarily the supply of housing on the market, but just the number of houses in the area, exploding, population exploding, and yet businesses are having a harder time finding workers than ever. You would think it would be the opposite. You would think, oh, there's all these people moving here. They're going to need somewhere to work, right? Well, these people, they're getting their money from somewhere. Is it all from stocks? I would think a good chunk of it is. If you have all these people moving into an area who don't need to find jobs in that local area, it's not like there's a ton of, white-collar careers here. We only need so many investment advisors. We only need so many accountants. We only need so many lawyers. I can't imagine that everyone who's moving into one of these brand new apartment complexes or one of these brand new suburban developments is a lawyer or an accountant or an investment advisor of some sort, I guess, or maybe a doctor. And so these are very strange times economically. I'm someone who, I'm not tooting my own horn, but just by virtue of the fact that most people don't think about the economy, I think about the economy a lot more than the average person. So I would think that I would at least have some idea of what's going on here. I should be able to make some sense of this situation, but I can't. But I got off on a bit of a tangent. Getting back to inflation, of course, if all of this housing demand is being driven by the general rise in asset prices, let's say these people are richer because their stocks are going up so quickly, they can afford to move down to Florida and just rent any apartment or buy any house at any price because they are so enriched by the boom in stocks and bonds, to the extent that they're displacing all of the lower income people who would be working in all of these jobs that are now being left vacant. That's certainly going to disrupt the economy. It's going to disrupt the national economy, not just any given local economy, because in those local economies that are starved for lower end labor, low skilled labor, I guess you could call it, the companies there, they might sell, they probably likely do sell products to the rest of the country. And so if they're having trouble, if they're having a supply side problems, that's going to drive up prices for their goods. And so I think I've just been thinking out loud here the whole time, but I think I'm starting to develop a case that the real estate bubble is creating, in part, the labor shortage. Because if real estate is so expensive that lower wage people on the lower end of the wage spectrum are unable to live in a given area, those jobs are going to go unfilled. You're going to have a perpetual shortage or an absence of low-wage workers. And so the only way, around that really is to automate them out of existence. And then I guess, round all these people up and put them in homeless shelters. I mean, this is part of, then it's kind of a chicken or the egg thing. Okay, so let's say prices are rising because there's a labor shortage, and there's a labor shortage because the cost of living, i.e. prices, are rising. So I guess I haven't figured much of anything out, have I? But I still think this is worth exploring. I mean, I think it does make sense that if the cost of living in a given area is sufficiently high to keep out a lower income percentage, the lower tier of income earners, well, any jobs for those people in that area, low-income jobs, they're going to go unfilled. You have to be making a certain, as an employer, you're going to have to offer a certain level of income in that area to sustain someone. You have to offer them essentially a living wage for that area. Now, there's always going to be, a small subset of demand for people who, are making a wage that is, below what they need to live on their own, because these might be people who live with someone else and who are just want to make some money. Like people who live with family or extended family or something like that. There are always going to be people like that who might work very, very low wage jobs well below, whatever the cost of living is. But that's never going to be sort of the average low-wage worker. The average, person on the lower end of the income spectrum in this country is somebody who's just trying to get by. And so they're not going to apply for a job paying $15 an hour in an area where you need to make $50,000 or $60,000 a year at the bare minimum just to get by. It just doesn't work. And so the rent is too damn high, as Jimmy McMillan would say. Housing prices are too damn high. Food is too damn expensive. Fuel is too damn expensive. There's not enough oil. Energy in general is being driven up by the Great Reset. You could say that all of this is beneficial to the Great Reset. But I won't get into that necessarily today. I appreciate everyone who's still with me. Who has come along with me on this journey trying to think through this stuff, because these are really important topics. I think it's the most important topic right now, and we don't understand it enough. And if we don't understand inflation, exactly why it is, the rate that it is, we don't know, we'll never even know how to start trying to bring that rate down, and we won't know when to expect that rate to ever come down. So, with that said, I will see you folks back here tomorrow.